Everyone, and thank you for joining us for our year-end tax planning webinar. I'm John Millay, the firm's Chief Financial Officer, Chief Operating Officer, and a wealth advisor. Tax planning is a critical component of our financial planning process. As the year comes to a close, it's the perfect time to review your financial plans and implement strategies to help you minimize taxes and maximize your savings. Today's webinar will be led by two of our experienced advisors and key members of our tax team. Vincenzo Testa. Vinny is a certified public accountant, a certified financial planner, and holds an advanced equity compensation designation. Vinny is joined by our colleague, Scott Strohecker. Scott is a certified financial planner and is an enrolled agent, the highest credential the IRS awards. During this session, Scott and Vinny will cover maximizing retirement contributions, going through strategies to make the most of your retirement savings, distribution planning, optimizing withdrawals to align with your goals and minimize tax impacts, tax deferral strategies, leveraging tools and strategies to defer taxable income, gifting strategies, supporting loved ones or charities while maximizing tax benefits, and tax updates, key changes you need to know as we head into 2025. So again, I want to thank you for tuning in with us today, and I hope you find this webinar on year-end tax planning both informative and engaging. Please welcome Scott Strohecker as he starts off the presentation.
Thank you, John. As John stated, we will be covering an array of topics today. Some of the topics may or may not be applicable to your specific situation, but I'm confident that you'll find at least one topic or one takeaway that you can benefit from today. With that being said, let's get started talking about maximizing your retirement contributions. For 2024, the maximum you can contribute to your employer plan, like a 401k, 403b, a state 457b plan, is $23,000. If you are 50 or older by the end of the year, you can put in an additional $7,500 as a catch-up contribution. Next year, 2025, the base amount goes up slightly to $23,500, while the catch-up contribution remains the same at $7,500. However, there is a new, quote, mega catch-up contribution limit next year for anyone between the ages of 60 to 63. In next year, 2025, anyone aged 60, 61, 62, or 63 will be able to contribute up to $11,250 rather than the standard $7,500 catch-up contribution. This mega catch-up was part of the Secure Act 2.0, but didn't take effect until 2025 tax year. The key thing to remember here is it is dependent on your age as of the end of the calendar year to see if you fall in that 60 to 63 age range. For self-employed individuals, there's a number of retirement plans available to you, like a simple IRA, SEP IRA, or solo 401k. With most of these plans, you have until you file your tax return to make a contribution, and that would include any extension deadline if applicable. This is different from your employer plan, which is funded through your payroll, and therefore you only have the remaining pay periods for this calendar year to get a contribution in. Additionally, it is important to be aware of the total contribution limit for employer plans. This year, the limit is $69,000, and next year that goes up to $70,000. Those limits are the combination of your employee contributions and any sort of match or profit sharing you receive from your employer as well. In addition to those retirement accounts, there's also traditional and Roth IRAs that are available. These are great accounts for anybody that is just starting off with a new job or even aren't eligible for their employer plan yet. For 2024, you can contribute up to $7,000. And if you are 50 or older, you can contribute an additional $1,000 or a total of $8,000 for the year. You have until April 15th of next year to make your contributions for 2024. And it's really important that you understand the eligibility rules, especially as to whether or not your contributions to a traditional IRA are deductible or not, and even the income limits, which could prevent you from making a Roth contribution. Additionally, we also have health savings accounts, or HSAs, which are another account to consider contributing to. It's arguably one of the best accounts that we have available because of the triple tax advantage. That is, contributions will go in, our contributions that go in are tax deductible on the way in. The growth is tax deferred, and withdrawals that are made for qualified medical expenses are tax free. Again, for these types of accounts, there are rules around the eligibility to make contributions. Two of the key factors here are you must be covered by a high deductible health plan, which I can go into those limits later. And also, you must not be enrolled in Medicare. That said, even if you are covered under a high deductible health plan, but you are enrolled in Medicare, you cannot contribute to an HSA that year or going forward. If you have self-only coverage, you can contribute up to $4,150 this year. Next year, that increases slightly to $4,300 for self-only coverage. If you have family coverage, you can contribute up to $8,300 this year. And next year, that increases to $8,550. And regardless of what type of coverage you have, if you're 55 or older, you can make an additional $1,000 as a catch-up contribution to the HSA. Now let's shift gears from the accumulation stage of your life, from where you're putting money away, getting ready for retirement, to the distribution stage. This transition can really be one of the most difficult times for any individual to get comfortable with, working every day, receiving a steady stream of income in the form of a paycheck, to now, trying to figure out how am I going to live off of the different resources and funds that I have available. So we here at Boucher really are here to assist you in making this as smooth of a transition as possible. The distribution planning really goes hand in hand with tax planning because of various treatments of the different sources of income you may have available. So let's just understand a few of the possible income sources that you may have. You may not be ready to fully retire, go from working 9 to 5 every day. So you may scale back with your current employer to have some part-time employment, or you may pick up part-time employment elsewhere. Often that, you'll still be a W-2 employee here, so you have the option for withholding, but it's just good to understand how that's going to work in your overall cash flow. You also may be fortunate enough to have a pension, which not everybody does, especially these days. You may also be receiving some rental income. While Social Security typically makes most of the headlines, especially these days, planning around when to start collecting is something we regularly work with clients on. Perhaps you also have some cash savings that have built up in your bank account, and you plan on using that for either maybe a few months as you start retirement, or even a few years. You just want to make sure that you know how far that can carry you, and then when you may need to tap in or use other resources as well. And last but not least, you have your investment portfolio as a source of income in retirement. With all these different sources, you need to make sure that you have a distribution plan in place and understand how these various investment accounts are going to be taxed for you. So let's take a closer look at that now. So let's start out by looking at your accounts as sort of 3 different buckets. We first have your brokerage accounts. Next, we have your pre-tax retirement accounts and then Roth accounts. For your brokerage accounts, you are taxed on interest and dividends that are generated in the account each year. These interest and non-qualified dividends are taxed at your ordinary income rate, while qualified dividends, these are dividends generated by US-based companies. You're receiving a preferential tax treatment by being taxed at capital gains rates, which are either 0, 15%, or 20%, as opposed to ordinary income tax rates. You will also be taxed on any capital gains that are generated within the account. These are typically generated by selling a security at a gain or from capital gain distributions from mutual funds. These capital gain distributions typically happen towards the end of the year, or it could be broken out, on a monthly or quarterly basis. But the most standard way you'll see it is November, December time. These mutual funds are kicking out distributions. So you need to make sure that you're aware of it and plan accordingly. Next, we have your pre-tax retirement accounts, like your 401ks, 403b, traditional IRAs. All of these will be taxed as ordinary income when you take a distribution. These accounts were funded with pre-tax dollars. Therefore, on the way out, you'll be taxed on each dollar that comes out. These accounts are also subject to required minimum distributions. In other words, under current law, once you turn 73 years old or are older, you must distribute a portion of the account each year, and that's based on the prior year-end balance and a factor which is determined by your age at year-end. And then last bucket that we have are your Roth accounts. These would be your Roth IRAs, Roth 401ks, Roth 403bs that are funded with after-tax dollars. Therefore, you didn't get any sort of deduction. It didn't lower your income. And distributions from these accounts generally are tax-free. There are some requirements that need to be met in order for that to happen, but generally, any distributions of not only what you put into the account, but also any appreciation comes out tax-free. Now, how do we bring, all these various sources of income and also the different buckets together and, make sure that you're aware of any tax planning tips and tools that you want to incorporate in your planning? First, you really want to make sure that you're paying in enough taxes to avoid a penalty or interest because of underpayment. While you're working, receiving income as a W-2 employee, you're having money withheld from your paycheck. So now you need to adjust accordingly to make sure that you have enough going in, again, to avoid penalties and interest. In general, to avoid a penalty or interest, you must pay at least 90% of the current year tax or 100% of the prior year tax. Though if your AGI, adjusted gross income, last year was over $150,000, you need to pay 110% of the prior year tax as opposed to just 100%. You should also know that the first $20,000 of retirement income is exempt from New York taxes if you're 59 and a half or older. That means, you take $20,000 out of your IRA once you're over 59 and a half, and New York State will not tax any of that money. Also, New York State pensions are fully exempt from New York taxation, so that's a nice benefit for anybody that has a New York State pension. Additionally, New York also does not tax Social Security, though there are a few states out there that do. Actually, Nicole and I from our firm took a closer look at this in a webinar a couple months ago where we comparing what it looks like to retire in New York versus other states. So if you want to check that out, that's posted up on our website. Getting back to some tips and tools, as you develop your distribution plan for your particular situation, you want to be aware of how it may impact your Medicare premiums. On the current slide, you can take a look and see that there's different break points for 2025 in relationship to your modified adjusted gross income and where you could have to pay more in premiums if you pass that threshold. Another tool to use that's great, especially these days, it's taken a front seat with planning because of recent law changes regarding inheriting qualified accounts, is Roth conversions. That's where you take money out of your IRA, you pay taxes on it at whatever your ordinary income tax rate is, but you're able to then move it over into your Roth where it's able to grow tax-free. And again, as we already learned, those dollars, in the future will come out tax-free as well. So you may, take the tax hit now, but later on down the road, you're not going to have to pay taxes on it. Or more importantly, when your heirs inherit that account and they have to start taking distributions, they won't have to pay taxes on those distributions. And then a final item from the Secure Act 2.0, there is another new provision that requires any catch-up contributions for certain employees to be made to a designated Roth account like a Roth 401k, Roth 403b. These certain employees that are required to make it as a Roth contribution is anybody that had FICA wages in the prior year that exceeded $145,000. So again, if you make essentially over $145,000 and you're making a catch-up contribution, you will start having to make those as Roth to your Roth portion, whether it's a Roth 401k or Roth 403b. You will no longer be able to put that in as pre-tax dollars into your 401k or 403b. This requirement, though, does not go into effect until 2026, so you still have some time to prepare for that. Next, we often get asked the question of how can I avoid or defer taxes? So let's go over a couple possible strategies that may work for you. First, we have Section 1031 or like-kind exchanges. A like-kind exchange allows real estate investors to swap one investment property for another and defer the capital gains until the sale of the subsequent property. This is key. The key here is really that it is going from one investment property to another investment property. You can't simply use this strategy with the sale or purchase of a primary residence, which is something we often get asked about. Next, we have a Delaware Statutory Trust or a DST. A DST is considered a 1031 exchange, except the mechanics of it are just a bit different for how it works. So it still allows for you to defer any capital gains from the sale of a property. However, you are now pooling your money with others in a separate legal entity. So it's no longer in your name solely, it is held within this trust, which is its own legal entity. So it does take some liability off of you there. So rather than having sole ownership of, this one property, let's just say it's a two-family property that you've been renting out, you now are a partial owner with pro rata interest in, one property that may be a bit larger, maybe a multi-unit rental property, or even it could have a combination of several properties within that trust, and then you just receive monthly or quarterly or even annual distributions as being part of that ownership. By using a DST, you are able to diversify into not only larger properties, but you're also able to, as I said, limit your liability and have some protection there. And you are a passive owner, all while being able to defer the capital gains from the sale of that original property, that maybe you no longer wanted to have to maintain and upkeep. Next, we have qualified opportunity zones and qualified opportunity funds. These were created back in 2017 under TCJA, Tax Cuts and Jobs Act. These qualified opportunity zones are economically distressed areas in the US. Each state identified where they really wanted to have some sort of economic stimulus put into, and then the Treasury certified them in order to, again, start economic growth and hopefully create some jobs while providing tax benefits to the underlying investors in these areas. The qualified opportunity funds are one way to invest in these qualified opportunity zones. By investing in one of these funds, you can temporarily defer taxes on eligible gains like capital gains or 1031 gains. Right now, as it stands, the deferral is actually only up until December 31st, 2026. So again, it went back into place back in 2017, but it's starting to phase out when you can defer the gains too. So you have about, 2 years of deferral, not as, much time as if you had initially gotten into this, but it's still a nice little benefit that you have remaining. At that point in 2026, you do have to realize the deferred gains that you had, though right now there is a fair amount of bipartisan support to extend the deferral deadline. So we'll be sure to keep an eye on that and put out any additional communications to let you know if that does indeed pass or anything changes there. But again, right now it's set to defer or end deferral in 2026. In addition to the deferral up to 2026, if an investor owns the qualified opportunity fund for at least 10 years, they'll be eligible for a adjustment in the basis of what they originally put in to the fair market value on the date that it was sold or exchanged. In simple, or in other words, you never get taxed on the appreciation of the qualified opportunity fund if you hold it for at least 10 years. I'm just going to use a quick example here that I came up with. So let's say you sell a property that you have for $500,000 and 200,000 of that is capital gains. You take that $500,000 of the proceeds, put it into a qualified opportunity fund, and rather than realizing that $200,000 in gains this year, you get to defer it until 2026. Again, 2026, it becomes a reportable realized gain that's going on your tax return. But if you keep your $500,000 that you put into the fund for at least 10 years, you'll be able to, let's say, sell it in year 11, and any appreciation, let's say it went from 500,000 your initial investment up to $800,000, you'll never be taxed on that $300,000 of appreciation, again, as long as you hold it for at least 10 years. Next, we also have exchange funds, which allow you to take a concentrated stock position. Let's say you hold a bunch of NVIDIA, Apple, Microsoft, really any concentrated stock position, and that diversify by pooling it within the fund, which is made up of an array of other stocks that have been put into this fund. So they're sort of commingling, though there are sometimes restrictions if a particular fund has too much of a particular stock, if it may no longer be accepting your Microsoft or NVIDIA based on what it already holds. So that's really one downside there, but it does allow for you to diversify without having to realize any gains by selling it and then diversifying across numerous securities or holdings. And finally, you can simply make sure that you hold onto your property for more than 1 year before selling it so that it's considered long-term as opposed to short-term. These long-term gains receive preferential treatment over short-term, which are taxed at ordinary income tax rates. Now, let me hand it over to Vinny to go over some gifting strategies.
All right, thanks, Scott. So with the holiday season on the loom, I think it makes sense to go over gifting strategies, and I'll start off by talking about charitable gifts in general. All right, so are you charitably inclined? So charitable gifts and charitable gifting are, really a great way to plan around your taxes and kind of diminish your tax liability, if you will. So one of the things you could start by doing is looking at the charitable contributions you're currently making, right? And some folks are making charitable contributions, but they're not itemizing their deductions, right? So charitable contributions are an itemized deduction. So instead of doing it year by year, you could potentially bunch those deductions into one tax year if you're not itemizing. And by doing that, you'll begin itemizing for that particular year and receive the tax benefit. So, it doesn't make much sense for, folks to be making cash contributions and not receiving a tax benefit for it. So bunching them together in one tax year could give someone that tax benefit. Another thing folks could do is if you have appreciated stock, right? Maybe you have some stock that you purchased years ago and there's some built-in gains in it, and you don't want to recognize that tax liability, but you're already charitably contributing in cash, right? You could donate appreciated stock, and it really gives you double the benefit, right? Because you're avoiding those capital gains taxes and you're receiving the tax deduction for the donated appreciated stock. So it's a good way to get out of a diversified, concentrated stock position, and also lower your tax liability, right? On the two forefronts of eliminating the capital gains and kind of capturing that charitable deduction on your tax return. Another great tool for charitable gifting is a donor advised fund. And donor advised funds are basically funds where you could contribute cash, or you could also contribute appreciated stock into, right? And they could be invested, right? And the initial contribution is the full tax deduction in the first year you contribute. But you're able to write checks out of the donor advised fund and give them to the charities that you're choosing, right? And you could do that year after year. It doesn't have to be in the first year that you contribute it, right? You could do that for years to come after you made that initial contribution. But the one thing to remember is that the full tax deduction comes from the initial contribution, right? So another way to bunch deductions, right? If you're making charitable contributions year after year and you're not receiving that tax benefit, you could kind of use the donor advised fund to bunch those deductions in as well, right? And you're just putting it in the fund. And the difference is that it could be invested, and you might, from the interest and capital gains that is generated within the fund, you might get a couple more years of charitable contributions out of that, and it's tax free. So really a great tool with the donor advised fund. And that's last but not least, you have the qualified charitable distribution, right? So this is when you take a distribution out of your IRA, and instead of the cash going to your hand, you have it directly go to the charity of your choosing. The one thing to remember with this, though, is you have to be age 70 and a half, right? That's a couple years below the RMD age, which is now currently 73. So if someone has an RMD and maybe they don't use it for cash flow, really a great tool here, right? Because it comes directly off your taxable income. Even though you're taking RMD, the IRS is, forcing you to pull a certain amount out of your IRA. But by using the QCD or qualified charitable distribution, you're able to kind of eliminate that tax liability, that taxable income on your tax return, and kind of eliminate that RMD. All right, so regular gifting is next. So any individual can gift up to $18,000 in 2024 to another individual. And in 2025, that number is going to inflate to 19,000. And they could do this without having to file a gift tax return, right? And there's a common misconception that gift tax returns have a tax liability generated with them. That's not always the case, right? So there's an estate tax limit for each individual, and that number is about 13 million in 2024. If you gift above those amounts, that $18,000 number in 2024, that estate tax lifetime exclusion gets reduced by the amount above 18,000, right, in any given year. So what the 18,000 is, it's giving you an annual exclusion from reducing that lifetime limit, right? So if you go above that 18,000, you are required to file a gift tax return, but in most cases, 99% of the time, there's not going to be a tax liability due. It's just a reporting requirement to kind of track that lifetime exclusion throughout the course of your life. That way, if your estate does go above, that $13 million lifetime limit upon your passing, you could owe some estate tax, and it would reduce the amount or it would increase the amount that would be subject to the estate tax. So that's really the reasoning behind it. So, gifting that amount, right? A married couple could gift 36,000 to an individual, but it's individual to individual in terms of the annual exclusion and what they're accounting for. And avoiding gifting appreciated assets to individuals, right? This could be a great estate planning tool when it comes to leaving, assets over to your beneficiaries, right? So when you gift an asset, the beneficiary that receives it is inheriting your cost basis, right? So if you're alive and you gift stock to your son or daughter, they're inheriting your cost basis. So something that, some tax planning can be done in this case, right? So maybe they're not as high of an earner as you, right? And you gift them stock, maybe they could sell the stock and, recognize a smaller tax liability than you would, right? And that benefits the family as a whole. But the one thing to remember is if you hold on to that stock or that rental property or that asset that is appreciated over time, upon your passing, your beneficiaries are going to get a step up in basis, right? So the cost basis upon your passing turns into the market value on the date of your death, right? So that's really a great tool because if your beneficiaries go to sell that asset immediately after your death, guess what? They have no tax liability, right? And that's a great estate planning tool. So sometimes it's, crucial to avoid gifting appreciated assets because that step up in basis can really save some big dollars for the family as a whole. All right, so let's segue into tax updates, and I'll start by talking about some of the details of the Secure Act 2.0 of 2022. So Secure Act 2.0 of 2022 was some legislation that was passed, and a lot of the factors of it go into effect in 2025 and had gone into effect in 2024. So I'll just lightly touch on some of the items, that are kind of brand new and that pop out at me and I think are really important. And Scott already went over the first one, right? So this is the catch-up contributions for those that are ages 60 to 63. So in employee retirement plans, they're allowing folks that are ages 60 to 63 beginning on January 2025. So this was not in 2024 that this was enacted. So this is just starting at the start of the year, allowing them to kind of have catch-up contributions that are a little bit more than what they are currently, right? So they're allowing those folks to kind of sock away some more money, and if they're behind on retirement, it's giving them that opportunity to kind of put some more money in their 401k or 403b or what have you. The RMD age, obviously another big item. So the age for the RMD, the required minimum distribution, and those who don't know what that is, it's the amount that the IRS says you have to take out of your tax deferred retirement accounts when you hit a certain age, and that age is now 73, and it's about 4% roughly of the balance of your IRA at the end of the year before. So the age was 72, they've increased it to age 73. And they've actually went a few steps further, and the RMD age will actually increase to age 75 for those who attain age 74 after 2032. So I know it's a little confusing, but at a certain point in 2033, the age will increase to age 75 for the RMD from where it's at currently at age 73. And then we have 401k match flexibility, right? So the Secure Act 2.0 allows companies the option to use 401k matches to pay student loan payments, right? We all know that if you work at a company, you put money into your 401k, your company, most of the time will match up to a certain percentage point in cash, right? It goes directly in your 401k. So now the Secure Act 2.0 is allowing companies to kind of give employees a little bit more of a benefit, right? A little bit more flexibility in the benefits they're offering their employees. And they're allowing that match to go directly to student loan payments rather than straight into the 401k. So, non-taxable benefit to the employee, and everyone's benefiting in that regard because just another fringe benefit that the employer isn't allowed to give the employee now. And then we have 529 plans to Roth IRAs. So 529 plans, for you, those of you who don't know, are college savings vehicles, right? So a lot of folks will open 529 plans for their sons, their daughters, their grandkids, and contribute money over the course of their adolescent life to fund their college in the future, right? And it grows tax-free, and distributions are taken out to pay qualified education expenses without penalty. Now, if you do have a little bit of a residual amount left over in a 529 plan, you're able to roll that amount over to a Roth IRA. And the maximum for any individual beneficiary is $35,000, right? And you can't do the $35,000 all at once. The account has to be open for 15 years. And you have to, kind of move. So the Roth IRA contribution limit is, correct me if I'm wrong, I think it's $8,000 now. So it's moving the 529 funds over to the Roth IRA on an annualized basis. The beneficiary has to have earned income, and you're able to do that up to the amount of $35,000. So really a great tool to kind of get some money to that 529 plan without penalty, over to the Roth IRA for a beneficiary. Okay. So provisions expiring after 2025. So the Tax Cuts and Jobs Act was passed in 2017 and was put into effect in 2018, right? So it has an expiration date in 2025, right? But Donald Trump was president when the law was enacted, and he just got reelected again. So there's a high likelihood that this is going to get extended. But I just wanted to talk about a few tax items that we could see if the law expires and it's not extended past 2025. Some of the more important items are individual income tax rates, right? They're going to revert back to pre-Tax Cuts and Jobs Act brackets and rates, right? So obviously tax rates were lowered a bit. They'll go back to the little bit of higher rates that we had prior to that bill being passed. We have the standard deduction. So this is going to drop down to the 2017 amounts, and that was $6,350 for a single filer and $12,700 for a married filing joint filer, right? So the standard deductions are a little bit more than that now, almost double, but those would drop down back to those 2017 levels. And then we have the SALT cap, right? With the state and local income tax cap on itemized deductions. So prior to the Tax Cuts and Jobs Act, you were able to take the combination of your real estate taxes and your state income taxes as an itemized deduction on Schedule A and your itemized deductions. They put a cap on that with the Tax Cuts and Jobs Act. So you're only allowed to take the combination of $10,000 between those two items. That cap would be removed, allowing folks to deduct more state and local income taxes, real estate taxes, and state income taxes grouped together on their itemized deduction. So could leave a little bit more of a benefit for some folks, and give them that larger deduction. And we have the return of job expenses and miscellaneous itemized deductions. So job expenses that you're coming out of pocket for that you're not getting reimbursed for by your job, those would be reenacted back onto Schedule A and allow you to take that as an itemized deduction. So like I said, the standard deduction has doubled with the Tax Cuts and Jobs Act, right? And it would drop back down to about half of what it is now, but you would be able to take personal exemptions, right? So you used to be able to take personal exemptions of $4,050 for each individual you were filing with or claiming on your tax return. So if you were married filing joint with 2 kids, you would be able to take $4,050 4 times as a deduction on your tax return. That would be reinstated, obviously creating a larger deduction for those with larger families, right? And that are taking the standard deduction. So could benefit some folks, could be a detriment to some folks. Then we have the qualified business income deduction. So this is really a pro-business tax law that was enacted with the Tax Cuts and Jobs Act. It allows businesses to take 20% of their net income as a deduction on their tax return. And obviously that lowers their tax liability. So that would be completely removed if this were to expire. And then I was just talking about the estate tax lifetime exemption limit. So that number would be cut nearly in half if this provision were to expire with the estate and gift tax exemption back down to about $7 million. So like I said, 2024 election results probably indicate a high likelihood that the current tax law is going to be extended past 2025. But just wanted to bring this up and mention it just in case it did expire. Okay. And lastly, you have some hot topics to talk about. So inherited IRA RMD. So you have your IRA, right? You had your 401k originally, 403b originally. It was rolled over to an IRA, or you had your regular traditional IRA. Somebody passed away and you inherited an IRA, right? There's rules around that. And the rules are that you have to liquidate the entire IRA within 10 years. But if the person who passed away was at RMD age, you also have to take a RMD within those 10 years, right? So that was kind of not black and white prior to 2025. So 2025, the IRS, these rules are set, and there will be no penalties waived for folks who are not taking that RMD. So really important to pay attention to. You don't want to be penalized for not taking an RMD, and also the planning around taking it out within 10 years, right? Because maybe some folks would want to take more than the RMD in 1 year and less, not a larger number in the next year. It's a lot of planning that goes around this from a tax perspective, and I think it's really important to work with a professional, on the strategy that you're using. And then we have equity compensation. Like John said, I'm an equity compensation associate, so I passed a test that was really geared around minimizing taxes and minimizing risk when it comes to equity compensation. Because if you're working for a company and you have their stock and you have their employer stock in your 401k, it's really not good to have all of your eggs in one basket, right? The forms of equity compensation, I mean, you have RSUs, restricted stock, incentivized stock options, non-qualified stock options, employee purchase plans, stock in your 401k. There's a lot of awards that companies are giving to folks nowadays, and folks are overexposed. They can be overexposed if they have a lot of their net worth tied up into the company they're working for, especially, right? I mean, that's a huge deal. If things go south of the company, their net worth goes down, maybe they lose their job. That's a big issue. So kind of minimizing your risk and minimizing your taxes, while planning around your equity comp is really important, and kind of getting out of those concentrated stock positions, using things like exchange funds, right? This is a fund that allows you to hedge your position in your equity comp. And, we do this for clients from time to time, and we do a lot of planning for clients from time to time around equity comp. So really important if you're receiving equity compensation, that is one of our service offerings. We do planning around that. Like I said, to minimize taxes and minimize, from a risk perspective. So definitely reach out to us and, inquire about that. And then we have loss harvesting. So this is something folks will do at the end of the year, right? So maybe they have a ton of realized capital gains throughout the year. At the end of the year, obviously right now is not that great of a time to do this because markets are doing very well, but maybe in a down year, or maybe you had a stock that went down in particular, an individual position, kind of looking at your portfolio and your taxable account, right? And saying, hey, maybe I should sell this position and kind of offset the gains that I've realized throughout the year, right? And that's beneficial because obviously it's going to minimize your tax liability. So capital loss harvesting, definitely a great tool. But the one thing to remember with capital loss harvesting is if you sell a position at a loss, you can't purchase it back within 30 days. That position or a similar position, that's going to be a wash sale, and the loss will not be recognized. So if you're doing loss harvesting, that's just one item to kind of pay attention to, and make sure that you're recognizing when you're selling. And I'll kind of segue to John to end the presentation.
Well, thanks, Vinny and Scott, for that informative presentation. As you could tell, they covered a lot of content, and quite frankly, could probably talk for another 2 hours. I think some of these topics we could easily do half-hour webinars just on a single topic. But I will say, if they did bring up a point that you want to explore further, reach out to your advisor. At the firm, we work as a team. So if your advisor for some reason needs to pull in some expertise, they'll pull in one of the members of our tax team, either Scott, Vinny, or Nicole. And also, as Scott and Vinny mentioned, several times during the presentations, one of the unknowns as we head into 2025 is whether the Tax Cuts and Jobs Act, the TCJA, will be partially or fully extended. And, President-elect Trump has made it clear that it's a priority of his administration to extend it. However, the reality is additional revenue is going to have to come up with somehow to close that budget gap. And, President-elect Trump has discussed increasing tariffs aggressively to make up that revenue gap. But we're just going to have to see how things play out in early 2025. So as we get more clarity on that topic, we'll be sharing updates either via a blog or potentially a future webinar. So stay tuned on that front. Also, just as a final reminder, a recording of this webinar will be posted on our website in the next few days. If you go to our website, we have a number of blogs, and Vinny mentioned equity comp. He did a webinar a while ago. That's on our website. Also, Scott referenced the prior webinar. So all that is available on our website. So definitely check it out at boucher.com. So again, I want to thank you for joining us today. I hope you enjoyed the webinar, and I hope you enjoy the rest of the day. Thank you very much.